G'day everybody, welcome to the Dynamic Investor Program video report for March to go with the written report. Now I've got a great deal to cover, and we've certainly had a good couple of months to start off the year, so I'll get stuck straight into it. First of all, just a reminder on the licensing and the general advice nature of this video. So a quick market overview from a fundamental point of view. Europe, it looks like the Greek debt crisis is probably contained. They've moved fairly quickly in recent days, and but I'd have to say that the problem is not solved. It's just been wallpapered over for a little while, and it's the same for the other peripheral countries: Italy, Spain, Portugal. They're all still really essentially in the same position that they were in over the last couple of years. Turning to America, the buying support for stocks in America has just been absolutely immense. It defies logic when you look at the fundamentals, but it is what it is, and it's certainly creating a lot of buying momentum, and it's been so impressive and so strong that you'd have to think, after we get a little bit of a correction out of the way, that the direction is still up. The reporting season in the States was actually quite poor compared to where it had been recently. There were a much lower number of stocks beat expectations, and the housing market, despite the fact that some people are now calling a bottom in the housing market, it's not going to recover for years, because the banks are now starting to put all the foreclosure properties back on the market, and that lack of recovery in the price of housing is going to eventually feed through to consumer spending. So fundamentally things aren't great in America. So is the stock market correct, or is it just in a dream world? Look, there's no question in my mind the stock market is being driven purely by liquidity and the expectation of liquidity. It's certainly not being driven by good fundamentals. So it's not exactly a dream world, but it's certainly not reacting the way that you would normally expect it to. Now, turning quickly to gold, and when I prepared this slide yesterday, gold was trading close to $1,800 an ounce. There's been a substantial fall of $90 overnight, which just smacks to me of just plain and simple manipulation. For gold to fall $90 overnight is just ridiculous, and someone's pulling some strings there as well, I'm sure. So for me, with gold, the trend is higher in the big picture view, but we've had a pretty significant turnaround last night, so that might take a few more weeks for the market to regather itself and before it pushes higher. But the encouraging thing is that gold stocks were just starting to join in, and they've actually performed quite well today. They've held up very well by and large. In fact, there's even a couple of gold stocks that are actually trading higher, so I take that as a real positive. Now, silver also broke the $35 resistance, almost got to $38 overnight before a big fall brought it back to $35. But look, this is just short-term noise in the market. It's nothing to concern us as investors. So let me just have a look at those particular charts before we move on. So we'll have a look at the S&P. You can see there's been an enormously powerful move here from October, and particularly since the end of December. It's almost gone up in a straight line. Now everything's overbought. The technical indicators are overbought, sentiment indicators are overbought, everything's overbought, but the market still keeps going up, and you wouldn't want to bet against it. I'm looking for maybe 13.19, a bit of a pullback to that area would be a fairly mild pullback. So we'll just have to wait and see how that plays out. Let's just have a quick look at gold. You can see here was a very sharp move overnight. It's brought it back to the 150-day moving average, but certainly has recovered around about $20 this morning as I'm doing this video. So I'm not, from an investing point of view, I'm not at all perturbed in the short-term gyrations of this market. This is silver on a daily chart, but if you put silver on a weekly chart, you can see it's not really that big a deal. It's just given back a little bit of the ground gained in the last few days. Similarly, let's look at gold on a weekly chart. You can see it looks completely different on that weekly chart. So yeah, some huge moves, but look, I'm not concerned about them in the slightest, really. Now let's have a look at some of the other stocks, and there were a number of half-yearly reports, so I'll just go through some of them quickly. Decmil, there was a small earnings decline in the half year, but that was really due to just their flow of contracting work. It was expected, and it really was compared to the previous corresponding period, which just happened to be fairly strong. So again, it's not too bad. It was an increase on the previous half, so the growth is maintained. They paid a maiden dividend of 2.5 cents a share, so they're obviously quite comfortable about sharing some of that gain with shareholders. And the most important thing for any business is the cash flow, and their cash flow was outstanding, nearly $30 million of actual free cash flow. So that's actually money in the bank. Forget profits that can be manipulated because you include that or don't include something else. This is the real amount of money that was left over during that period. So $30 million of free cash flow in the half is a good result. They've now got $100 million cash on hand, which they can obviously then funnel into the opportunities in Gladstone, which are just immense. They really are. There was a significant margin improvement in the civil construction area, which is good to see, and they've got an order book currently, so this is confirmed contract orders of $500 million. So that's a very, very robust order book. So you'd have to think the next half-year report and full-year report should be pretty good. Now, just looking at it from a strategic point of view, they really are beautifully positioned to do civil works as well as the accommodation work in Gladstone. So I think the future for Decmil is really good, and they've got a current tender pipeline of $4 billion, would you believe? So they're not short of some opportunities. I'll just go through MTU and then we'll have a look at both those charts. Now, MTU's half-yearly report also was outstanding. Profit was up by 45% to $16 million, but $3.5 million of that was a bit of a one-off profit, so pull that out and we're back down to about 13. But the company did say to expect the second half to be even stronger, so things really barreling very nicely for MTU. They've got a margin target of 15% and they are achieving that, so that means their business is on track. And the recent improvements they've made in operational efficiency should raise the margin further. So everything in this business is really heading in the right direction. Now, the return on equity as of June was 43%. I don't have an updated figure just yet. And looking at them from a strategic point of view, so the half-yearly report tells us what's been, the strategic side is what's coming, and so far they've made a number of acquisitions. They seem to have been managed well, and that acquisition process looks sustainable, and they've been able to make acquisitions very cheaply, and they've just made they've just made a couple of acquisitions at basically 3 times EBIT, which is earnings before interest, tax, depreciation and amortization. So it's, just think of it as sort of like a precursor to net profit. So that's extremely cheap to be able to buy companies at 3 times EBITDA. Now let's just have a look at those couple of charts. So first of all, we'll look at DCG. So DCG was an entry for us at $2.35. You can see it's had a great run. It's now up at, it's got up to nearly $2.90. It's at $2.75 at the moment. Let's just put that on a weekly chart, which is a bit more appropriate for us to be looking at. So I see no reason why the share price can't really make its way towards the mid $3 area, but let's remember what we're doing this for. DCG is in this portfolio because over the next 3, 4, 5 years, the way their dividend growth is going, it's highly likely that we're going to be achieving a very substantial dividend stream in 3 to 5 years time. That's really the prize that we're after, because that means then we don't have to worry about what the stock market is doing. But I think along the way, with an entry price at 235, I think we're also going to make some very tasty capital gains as well. Let's have a look at MTU. MTU we entered at $3.20 and again at $3.36, and you can see it's really just starting to trend up again now. It's still very good value, and from a technical point of view, again, I don't see any reason why this won't head towards $4. But again, the long term here is all about building up a revenue stream so that in 3 or 4 or 5 years time we might be getting 20, 30, 40% return on our initial investment. That's really the purpose for this particular stock.
If you want to trade and invest with us with a big edge on the market, go to our website specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.